If an individual racks up a mountain of credit card debt, lenders get nervous. The logic is simple. The more you owe, the riskier you become, and banks penalize that risk with punishingly high interest rates. Yet the United States government operates in a completely different reality. Despite sitting on a historic $34 trillion mountain of national debt, it effortlessly sells long-term bonds to the world at a mere 4% yield. This creates confusion because we instinctively apply personal finance logic to sovereign nations. We assume the bond market is pricing debt based on the government's ability to pay it back through normal tax revenue. But governments control their own currency. The U.S. can always create more dollars to avoid a default, meaning the real risk for a bond buyer isn't bankruptcy, it's that inflation might erode the value of their return. Since default is off the table and the size of the debt isn't scaring investors away, we have to look for the specific mechanic holding that yield at an incredibly resilient 4%. Before investigating global markets, we have to look at the buyers inside the U.S. borders, as the vast majority of American debt is actually purchased by Americans. Much of this comes down to local bias. Investors inherently prefer the familiarity and perceived safety of their own nation's legal systems and securities over the risks of sending capital abroad. This chart shows the Federal Reserve's balance sheet staying below $1 trillion for years, before rocketing up to nearly $9 trillion. By printing money to absorb this debt, the Fed funded the government while inflating asset prices, keeping American demand consistently high. But the dynamic shifts when we look at foreign institutional buyers, the central banks and sovereign wealth funds seeking a secure place to park their national savings. These entities aren't dealing in millions or even billions. They are trying to allocate tens of trillions of dollars in excess capital. The sheer, incomprehensible scale of this global wealth creates a unique crisis. There are no financial vehicles on Earth large enough to physically hold that much money safely. Standard alternatives fall short. The entire cryptocurrency market is vastly too small to handle institutional trillions without being completely overwhelmed. Physical gold is equally limited. As this refined bullion suggests, the market simply lacks the physical depth to accommodate the entirety of global sovereign wealth. These foreign buyers require liquidity above all else, the ability to move $50 billion on a whim without accidentally crashing the market price. The paradox: to have a market liquid enough to absorb trillions, a government must issue astronomical debt. America's massive debt pool effortlessly swallows these financial whales, allowing massive capital flows without the volatile ripples that would destroy a smaller economy. Europe cannot provide this depth. Despite a huge collective GDP, the Eurozone's debt market is fragmented across nations, splitting liquidity into smaller, less reliable buckets. Japan's historical zero-yield environment and China's strict capital controls similarly disqualify them as global safe havens. Neither can offer the combination of scale and openness found in the States. This $34 trillion debt pool serves as the exact mathematical prerequisite that makes the U.S. market the only viable safe haven for the world's biggest financial whales. This suggests a new rule for the modern era. Massive government borrowing is a strict requirement for anyone who wants to host the global financial system. The consequence is an unavoidable monopoly. The United States remains the anchor of the global system because it is the only entity capable of providing the necessary volume of debt. Global institutions are effectively trapped. They are forced to buy U.S. debt because no other market offers the unmatched depth required to handle their capital. This reframes the original mystery of the 4% yield. That yield reflects the cost of accessing the world's deepest liquidity pool. It functions as the parking fee the world is willing to pay to use the only financial lot large enough to hold its money. This dynamic creates a self-sustaining loop. America continues to fund itself comfortably because the world has no other place to go. Until a competitor superpower creates a unified, massive, and open debt market, the dollar's dominance and that resilient yield will remain the centerpiece of global finance.